Good morning, everyone. Welcome to WSRB's Leadership Webinar Series. So excited to be with you today. Our special guest is Dr. Robert Hartwig, who serves as the Associate Professor of Risk Management, Insurance, and Finance at the University of South Carolina. Most of you know Bob from his time as president of the Insurance Information Institute, where he served our industry in a spectacular fashion as someone who went out and explained how insurance works, and he's very, very good at that. Welcome, Bob. Good to have you with us.
Glad to be here, Carl, and it's always my pleasure to do media work. In fact, I've got interviews stacked up right now, right after this webinar, right before this webinar, so on a wide variety of issues. And I'll tell you, insurance is always something people are interested in around the globe. Literally, this is my third webinar of the day. I started one in London with participant where one of the panelists was in Finland, one was in Germany. And one was in London, and then I moved to New York, and now I'm out in Seattle.
So, moving around the world in just one day. I love it.
Exactly. I got to go to Hawaii or Japan next, I think. It's going to be the next.
One of the things that I really value, Bob, about you is our industry is vastly misunderstood, and clear communication about how it works is such an important thing, and you're a master of that. And so just to jump in, walk us through the P&C financial industry position as we kick off 2025.
Right. And Carl, I think I'll weave that into a discussion about something you just met, because I think it's on a lot of people's minds today if they are in the industry. And so, the good news in terms of how the industry is doing is it's strong, stable, sound, and secure.
Yeah.
And that's what everyone, whether you're in the industry or whether you're a consumer, if you're a policyholder in Los Angeles, or a policyholder in Miami Beach, or anywhere in between, you should be happy to hear that. What the narrative often is that, the price of insurance is too high, my premium is going up. You hear some misinformation and disinformation that insurers are canceling policyholders in California, for instance, just before the fires broke out. And the reality of it is that what insurers are doing is making sure that they are there in order to be able to make good on the promises that they are making to millions and millions of, literally hundreds of millions of people and businesses all across the country every day. And so I do spend a good part of my day sometimes trying to correct the record. So yes, State Farm over a period of time, in fact, did non-renew policies in California. It did not cancel policies just before the fires broke out. State Farm would have loved to have stayed in California, were it not for the fact the regulator did not allow them to include reinsurance costs or models that were informative of what was likely to happen in terms of wildfire risk. They were precluded from doing this. In a state like Florida, same situation, except we had trial lawyers run amok who were filing a record number of lawsuits related to roofing claims, of all things. And so again, what we have is a market that actually functions, property casualty insurance, strong, stable, sound, secure. But if you have a regulatory environment in which insurers are not allowed to charge a premium that reflects the underlying risk, this is going to be no different, Carl, than, if we put a price cap on Eastern Washington potatoes, you just won't get as many potatoes, okay? And you're just not going to get as much insurance if you put a cap on the price of insurance. And so California was an experiment, a failed experiment in price caps. That's all it was. Now, a regulator will try to say, I'm protecting the consumer and so forth, but all they wound up doing was sending people into the state-run FAIR plan, which, if it were a private insurer, would be declared bankrupt instantaneously,
right.
Which will have to be bailed out ultimately by insurers, who will then recoup these monies ultimately from policyholders. Unfortunately, a lot of them from policyholders who don't even live in the wildfire area. So that's not particularly fair at all. So, but to get back to your original question, I'm very happy with the industry's performance over the past 5 years. 5 years ago today, we were staring down the gun sights of a pandemic, the likes of which we hadn't seen in 100 years. A lot of uncertainty associated with that for the industry and for the economy. We rode those economic tides both into the pandemic and out of the pandemic. Uh, and while the rest of the economy was struggling with supply chain and distribution, these kinds of issues, struggling with inflation, the insurance industry continued to meet the challenge of an economy that was sustaining some very volatile periods of time, investment markets that were very, very volatile during that period of time, and continue to be to this day. And so again, full circle. The one thing we're not talking about today, we're talking about wildfires, and we might be talking about higher prices for insurance, but we're not talking about insolvent insurance companies that can't pay their claim.
Right.
And so that's something I think everybody in this industry ought to be proud of.
I agree with that. One of the things that we're seeing out here, Bob, and I think it's across the country, is the long tail, because insurers in most states have to file their rate increases based on historical data. And so during the high prices at the gas pump, during the high prices for groceries, there's a long tail on that, I believe, for claims, because you're looking at higher labor costs, looking at higher material costs that are just now hitting the market. And I think that's creating some of this, wow, rates are just going up ridiculously. And it makes it even more important for our insurance buyers, the insurance buying public, to understand how it works. But am I correct on that? That we're seeing this?
Yeah.
Now it's hitting the industry, and people go, well, you're now raising your rates. Why are you raising your rates now?
Right. There is a lag. In fact, as inflation was getting going in 2021, and it peaked in 2022, insurers were only beginning to see the higher claim costs at that time. They have to wait for an entire policy year's worth of policies to effectively expire. They collect that data, they build that data into new rates, and really rates only began to rise starting in late 2022 into 2023. And something like in personal auto, they didn't peak until the middle of 2024, which was 2 full years after inflation as experienced by the overall economy actually peaked. The other thing that people are generally unaware of is that inflation as experienced by insurers has been materially higher than even the overall consumer price index. So for instance, the cost of rebuilding and repairing homes and businesses that are damaged from whether it's wildfires or hurricanes and such, in the period from just before COVID through the middle of last year, rose about 42%. That compares to about 21% for the increase in the overall consumer price index at that period of time. Same thing for labor, not quite as bad, but still about 50% higher. So insurers are experiencing inflation in a way that's more intense than the overall CPI than the average person sees. And so I can understand why the average person doesn't really see that. What they are seeing in 2024, they saw their auto policy or their homeowner's insurance policy renew at plus 15, 20% in some cases. And whereas the overall inflation rate was up about 3% last year.
Yeah. And we're definitely seeing that happen. On that same concept, though, when we talk about inflation, the Fed's been lowering interest rates, doesn't appear to be impacting the borrowing rate. What's happening there, and what's your take on where things might be going this year?
Right. So I think there's a big misconception about what interest rates the Federal Reserve controls. The Federal Reserve controls short-term interest rates. And so the Federal Reserve has managed to lower short-term interest rates, being satisfied that some progress has been made in the war against inflation. What the federal government does not control is longer-term interest rates. So we look at the 10-year Treasury yield, for instance. It's relatively high right now, and mortgage rates are keyed off of that, as are many credit card rates and such. And so a mortgage rate today is somewhere around 7%. Now, it's not going back to 3% where it was during the financial crisis, and it shouldn't. That was a rate that was held artificially low. But many people were hoping to see something lower than 7%. But there are a number of factors driving that today. And so first of all, is we have somewhat persistent inflation, particularly in the service side of the economy. All the inflation today is coming through the service side of the economy. So this is everything that people pay for haircuts to hotels, these are the things that are driving inflation today. Whereas early in the pandemic, it was goods. So things that people wanted. And they were sitting away clicking Amazon, and there weren't a lot of things to buy, so the price kept going up. So we've got this issue right now that inflation is has been a bit resistant. The Fed is going to be hesitant to lower interest rates, but longer term, we have investors, bond markets in particular, they're looking towards more deficit spending. There is absolutely no restraint in Washington, irrespective of political party, in terms of reining in spending. It's very popular to spend money that your children and grandchildren and great-grandchildren will have to pay for. Very popular to spend other people's money, apparently equally popular to spend your own children and grandchildren and great-grandchildren's money. And so, again, this goes across both parties. So we're looking at more deficit spending. We are also looking at, the Federal Reserve is looking at the possibility of tariffs being imposed later this year. Tariffs are a tax. They will absolutely increase the cost of everything that we import from wherever we impose tariffs. And the largest tariffs are being targeted towards, at least from what we hear, towards Mexico, Canada, and China, which are three of our largest trading partners. And when it comes to something like when you think about automobiles and automobile parts, you slap a 25% tariff on these things, that's going to smart. And the same thing for, say, imported lumber from Canada, for instance, that could be, vital in terms of rebuilding the thousands and thousands of structures that have been damaged or destroyed there. If you raise the price of this very fundamental input, it's going to raise the price of insurance claims. It's going to raise the price of new homes. It's going to ultimately raise the price of insurance. So this is a new strategy where we have not imposed tariffs of this magnitude since the 1930s, which last I checked wasn't a particularly great economic era, but we'll see. And it's a bit of a large economic experiment. It could be the fact that the new administration is jawboning. It's to some extent, and using this as a sort of a bargaining technique or a bargaining chip to try to obtain some other means and some sort of ends. We'll see.
So when you look at things like as you mentioned, the California experiment of price caps, and now we're talking about tariffs, it's a common sense that you can't add a cost and the company's not going to eat it. They're going to pass it on. And that happens across the economy. Last year, we talked about the possibility of a recession and a potential Goldilocks soft landing. What's your take on where we are, and will that roll into 2025?
Right. So, yeah, thanks for bringing that up, Carl. So I'm probably one of the few people, even going back to 2022, when everyone was predicting recession, I said it was unlikely. I held that in 23 and in 24, and lo and behold, we have not had a recession. Right. I was predicated on my comments and my thoughts on that were predicated on the fact that labor markets remained relatively strong. There was a lot of pent up consumer demand. Again, unemployment rates were very low, and you just don't have a recession when you have an unemployment rate that's below 4%. It's just inconsistent. Now, the Fed did raise interest rates, but again, labor markets remained relatively robust. So the likelihood of a recession in 2025 is very, very remote. And I wouldn't call it particularly likely even in 2026 at this point. Now, in terms of economic projections, we are looking at a slowdown in economic growth in the second half of this year. Again, that is predicated on the implementation of tariffs in the United States against major trading partners, and that many of those trading partners do retaliate. Many people forget about that. Imposing tariffs is not a one-way street. We don't just impose tariffs on anybody with impunity. Our major trading partners will likely retaliate in kind. That will likely result in a slowdown in economic activity in third and fourth quarters of this year. Now you have to weigh that against for 2026, where we expect by the end of this year there will be an extension of the tax cuts of 2017, and perhaps they're going to be made even more generous in some sort of a way. That creates a stimulus. So what you do is you have a deficit-fueled stimulus in 2026. Maybe some of it genuine economic growth, but again, some of it also stimulus, and that will offset some of the negative effects associated with tariffs. So this is some, kind of very international sort of economics kind of discussions combined with fiscal policy. It gets kind of complicated to work out all the variables, and it is a significant departure from fiscal policy, and we're also joining some of our fiscal policy in terms of raising tax revenues with tariffs with sort of our geopolitical desires, so that we are saying, well, maybe we'll lower the tariff against you if you agree to do this, that, or the other thing, and as opposed to simply negotiating, terms of trade apart from other sorts of conditions.
Yeah. And we've touched a couple of times on the impact of the election, maybe more directly, more of a direct concept. We've got the Republicans in control of the legislative and the executive branch for the first time in a while. Does this help the industry? Does it hurt the industry? What kind of, in a broader way, what is your forecast on that?
So, the industry is one that, again, has been around for hundreds of years and has been through every possible combination of Republican, Democrat, and everything in between. And it was 8 years ago when Republicans last had control of the House, Senate, and the White House during Trump's first term. The industry was doing well, all things considered, during that period of time. Interest rates were very, very low as a result of interest rates being held artificially low by the Federal Reserve. That did harm investment income, but that was separate and apart from the administration. We did have our challenges with catastrophe losses, and that's going to happen no matter who's in the White House. And that gets to one of my larger points. I have a chart that I show in presentations every 4 years. I roll out and update it. And I actually show under which party, Republican or Democrat, in the White House, does the industry perform better. And I go all the way back to, I think, 1952 with this. So I've got, almost over 70 years worth of data. And what it shows is it makes no difference. Okay. Statistically, there's no difference. The industry performs just about the same under Democrats and Republicans. It can go a little bit one way or the other. But the reason for that, when you step back and think about it, it kind of makes sense. Mother Nature doesn't care who's at 1600 Pennsylvania Avenue. Yeah. Hurricanes are going to happen. Earthquakes and tornadoes are going to happen. Floods are going to happen. Right. You could argue there's maybe some influence associated with economics there, but in the greater scheme of things, it seems to make no sense, or it makes no difference.
No difference. Would you say, it's just as we think about it, our industry is based on actuarial science, and is that part of what makes it so stable? We're predicting the future to a degree, but this stuff's been going on for years. Fires and robberies and natural disasters. The stability of the industry, if we look back to that financial crisis, even in 2008, 2009, I don't believe, and you know this better than I do, I don't think any insurance companies went out of business there, though many banks did.
No, we had some companies. So AIG had a difficult period, but it didn't really have to do with their insurance operations. Right. But so actually, you're correct. There were no insurers that actually failed during the financial crisis, whereas hundreds of banks failed. Right. We had a few banks fail, I believe, in 2023 as well. We didn't have any insurers fail during that period of time. As well. So insurers are fundamentally different from banks for a wide variety of reasons. You can't really have a run on an insurance company, these sorts of things. And so again, that's part of the reason why, the industry is very strong, stable, sound, secure, very resilient. And insurers don't build their models around who's in the White House. Okay. Yeah. As you mentioned, they build actuarial models built on, what the data show. And we're going to do our best in order to estimate what expected frequency and severity of losses are going to be in the year ahead. And generally speaking, that's a calculation that it doesn't matter who's in the White House, who's in the State House. But that doesn't mean we're divorced from politics, because insurers spend a lot of time. I spend a lot of time banging my head against the wall, as do lobbyists, on certain issues. I mentioned California, not allowing, being the only state in the country to not allow insurers to incorporate reinsurance costs in their rate. On what planet does that make sense?
Right.
To not be able to use models that are better at predicting and modeling climate-related risks. Not allowed in California, in a state that claims to be on the cutting edge of everything related to climate change. So It makes no sense whatsoever. So insurers are banging their heads against the tort environment in many states, particularly states in the Southeast, which are effectively owned by the trial bar. Georgia, South Carolina, Florida, Alabama, Louisiana, states like this. Unfortunately, you've got the fox in charge of the hen house in many of these places, and they create laws and regulations that benefit themselves. I mean, in parts of the Southeast right now, we're having what many are calling a tort liability crisis. It's the ways in which the litigation environment operates in many of these states, again, including South Carolina, is like no other place in the country. And the deck is really stacked against insurers, which means it's ultimately stacked against, in this case, businesses. What many people don't understand, I think, is that insurance is a pass-through. Insurance, a premium, a rate, is a messenger about risk. When you in California receive a renewal on your homeowner's policy or commercial property policy that's up 18%, you're likely to be upset. And you may lash out and say, that greedy insurance company. What the insurance company is doing is simply passing along a message about risk that is found in the data, and nothing else is there. That's really what it is. And I think that fact is simply unappreciated.
Yes, I agree. I love how you said that. I hadn't heard that stated quite that way. A messenger about risk. I've sometimes said when explaining to a person about insurance that the insurance companies is really kind of a referee in between the contract, what we promise in the contract, and what we deliver to the policyholder, and they've got to honor that and say, okay, you have a legitimate claim and you don't, and that is part of that whole claims process, right? We talked a little bit at the beginning about natural disasters and whatnot, and you got into that a bit. Let's pivot to talk more about that directly. The Hurricanes Helene, Milton, the latest California wildfires. What's your take on how that's going to impact pricing, reinsurance, and maybe even more important, the regulatory environment? Is it a wake-up call to regulators that you touched on it a number of times? Especially if you look at a mutual company, there's the policyholders own the company. There's no motive for that company to overcharge, but they have to charge enough to stay in business. And what do you think in terms of? Do you think this is a wake up call, or how do you think that's going to affect the reinsurance regulatory environment?
Carl, I think I've been saying that for many years I've delivered wake up calls, and but many regulators remain asleep. And I mean this in a respectful way to consumers as well, but many consumers have been lulled to sleep by regulators, okay, and others. Many homeowners, millions and millions of homeowners, have effectively been lulled to sleep by promises of subsidized flood insurance, for instance, on the coast of Florida. And have been lulled to sleep in California because they can get a cheap plan, a cheap policy through the California Fair Plan, which doesn't really reflect the true cost of providing coverage in wildfire-prone areas. And so regulators and legislators who are effectively obscuring the price signal that is being sent by insurers by offering them what amount to subsidized alternatives, aren't doing them any favor, and they aren't doing themselves a favor. Although in the very short run, they are currying the favor of voters who will vote for them. If you run on a platform in California and probably many other states, saying that, you know what, I'm going to limit the increase in home and auto insurance prices, you're going to be more popular than a candidate who says, I'm a believer in free markets, and what we want to do is make sure that people who live in coastal areas or areas that are prone to wildfire truly understand the risk.
Right.
Okay, it's going to be more popular to say the former rather than the latter. And we've seen generations and generations of regulators, legislators, state insurance committees, Republican and Democrat alike, fall into the same trap. And unfortunately, people are lured into that trap time and time and time again.
Yeah.
And that's why we wind up with massive overbuilding in these vulnerable areas. And, you know, to be honest with you, Carl, I don't really see an end to it. There's nothing out there I see that would bring an end to this.
That's unfortunate too. It would be so good for I think probably our best hope for future is to have our insurance by public, the citizens and residents of these areas, be willing to take responsibility for it. I've seen some who've said so. You know, I rebuilt. I think John Stossel at one point rebuilt his house twice on the South Carolina coast. He did a documentary about something. He goes, I'm taking from other people and I'm going to stop. So he quit. He sold the land,
quit doing it. Right. Yeah.
Somebody else built there and got it blown out again. But,
yeah.
But people understand that we as the insurance buyers, not only us in the industry buy insurance, we need it, but that we're responsible for how we apply risk and need to be willing to say, if I'm going to build a house on top of a mountain with a narrow gravel road, probably no one's coming to put that fire out when wildfire strikes. And I need to be willing to pay more for insurance if I can get it.
Right. And, you know, part of this involves getting more information into the hands of property owners and property buyers, property shoppers. For instance, if you go on something like Zillow nowadays, there actually is some hazard index information, and they rate a variety of indices. I think, you know, from fire to
crime. They got crime in there.
And yeah, maybe there's crime. Yeah, there's a number. There's like 5 or 6 different elements in there. And I think people should begin to take that into account. The same way that in the auto side of the insurance business, this industry was very successful in getting people to pay attention to safety ratings. And, you know, the Insurance Institute for Highway Safety, and people now they do check out the safety ratings. They want to make sure their family is safe in that car. And so the industry continues to provide that service, but really pioneered it. And you and I can remember those, you know, very graphic videos when, you know, we would see 2 cars going 50 miles an hour crashing into each other, and we'd see which one had the better engineering and which ones were the crash dummies likely to indicate someone survived.
Right.
And so we need to bring that same mindset into where we live. You know, very often, you know, it's easy to be go into a new car and be seduced by that new car smell. But people have gotten over that to some extent. They understand that safety is really, really important. And they actually understand that having a car that's safe and so forth can actually help them save money in the longer run. We need that same mindset with a home. It's that sort of information, which I argued should be in every property transaction as a mandatory disclosure. I remember testifying in a congressional committee years ago on flood insurance reform, and sitting in the hearing room are a bunch the Realtors Association, who was absolutely adamantly opposed to that. Okay, so you have more information about what your countertops are made out of than whether your house is going to be destroyed by a wildfire. Okay, and I thought that was pretty pathetic.
That's unfortunate. Out here on the West Coast, earthquake is another big risk for us, and that's something that I don't know if Zillow has that info. We certainly have it. We provide it to our underwriters and raters, that type of information as part of our risk assessment suite. And so if you haven't checked out the Risk Assessment Suite tool, latent marketing promo, please do. I think you'll get a lot of value from it. Cover a lot of different risks that are excluded, but not maybe aware. Companies are not aware sometimes they're insuring something. We can help with.
And Carl, you're right. I mean, hey, nothing wrong with a blatant advertisement here, because that's part of the value that SRB brings and has been for many decades bringing to the marketplace. And you continue to innovate new tools like your slope tool, for instance, that it might not be obvious to the average person that the slope of a property can affect the ability to put out a fire, for example. And it might be obvious how far you are from a hydrant or from a fire department, but there's a lot more that goes into it than that.
What do you think the reaction of reinsurers will be to the California wildfires? How about areas where things are a bit less volatile as well? I mean, it's got to be some kind of impact. What's your thoughts on that?
So the good news is that after 7 years of pretty steep increases for property catastrophe reinsurance, as of 1/1/25, we actually saw the first decrease since about 2016. So that's good news. So that's in part because we've seen more rate flowing through to reinsurers, and we've also seen a restoration of a lot of the capacity that was drained away from high inflation and high catastrophe losses a few years back. So that's good news. The bad news is that sort of decline doesn't necessarily carry forward into what we would call loss impacted accounts. Okay, so to the extent that we've got areas like parts of California, parts of Florida, and so forth, they are unlikely to see, not surprisingly, some kind of substantial reduction in the price of reinsurance.
Right.
Because the risk is large. We don't see the area suddenly being inundated with twice the amount of precipitation in years ahead that it was once before. The models call for something actually very different from that. Part of it is how the reinsurance markets and insurance markets react in somewhere like California is going to be, do they rebuild smarter? Do they rebuild better? Both not only in terms of structures, but also in terms of vegetation and these kinds of things that can give rise and allow these wildfires to spread. So I think there's a lot of unanswered questions, but loss impacted accounts for the reinsurance side, I would continue to expect to see some pressure there.
Excellent. Thank you, Bob. That's good stuff. We're going to pivot to the Q&A, and our first question is another one of our board members is submitting, Chuck Chamness, who, as you may know, recently retired CEO of NAMIC. And here's the question. Today in Washington, D.C., the other Washington, there's a discussion about a federal backstop program, wildfire coastal wind, similar to flood insurance, the National Flood Insurance Program, or perhaps part of the existing dysfunctional, there we go. I didn't read the rest of the question. Dysfunctional flood insurance program. What do you think of this idea?
Well, it might be a little bit of a leading question from Chuck, but yes, this was when I heard about this, I think a few weeks ago for the first time. It's not actually the first time something like this has been bandied about. There's been variations on the theme, but we could start with this. Flood insurance programs have been around 60 years. How's that work? Okay. Okay. The proponents of a federal backstop for coastal wind and wildfire are claiming that there will be no burden on the taxpayer. But look at what's happened to the flood insurance program. And then this would be the flood insurance program on steroids. The sheer number of miles of coastline or square miles in the wildfire urban interface would literally kind of drown out the exposure that we see with respect to flood. And so with, I would say, absolute 100% probability, were this a plan to go through, we would very quickly become a burden on taxpayers. It would compete against traditional reinsurance, which is, of course, priced to the market. and it would become your latest and greatest entitlement program. And once that genie is out of the bottle, you'd have a very, very hard time getting it back in. Now, maybe they could send this idea out to Elon Musk at the Department of Government Efficiency, and let's see what he thinks about it. Hopefully, he's smart enough to see that creating these subsidies wouldn't be a particularly great idea. So, again, Chuck's been around a long time. I've been around a long time. You have too. It's kind of like, as Mark Twain said, the future doesn't repeat itself, but it does rhyme. And this is something like that. And it was a bad idea in the past, and it's a bad idea now because there's, on both sides of the aisle, and there are supporters on both sides of the aisle. They're not being realistic when they make the assumption that this will not eventually have a burden on taxpayers.
Well, it has to. There's no way around that. And that's the part that I think is frustrating, is the things that they do that play well politically actually harm the people that they're purporting to help.
They're actually going to put more people in harm's way, because the effect of this is what we would call moral hazard, meaning that you create these effectively a type of insurance that is subsidized, and you actually are going to incentivize more people to live in harm's way because you're going to reduce the cost for them to do that.
Right. Absolutely. Another question here coming from Josh Bailey. Along the same lines, we're talking a lot about how the political environment can affect our industry. Tariffs on materials like lumber are often designed to support domestic industries, but they can also drive up rebuilding costs, which impacts insurance claims and premiums. Do you think the potential benefits to U.S. businesses and industries outweigh the challenges that these costs pose to insurers and policyholders? Is there a balance that could be struck?
Yeah, when we think about tariff against lumber, there's no need for it. I mean, quite frankly, I mean they're largely lodged against Canada, which is a company that has a large forestry products industry. It does export lumber to the United States. I know the United States will occasionally argue that the lumber is being dumped into the country. I'm not sure there's a lot of evidence associated with that. But what I do know is that if you put up a 20-25% tariff against Canadian lumber, the cost of rebuilding homes in Palisades in Los Angeles is going to go up. It's going to go up in faraway Florida as well. And so that is ultimately going to drive up claims costs. So, when we think about how these tariffs might be imposed, will there be carve-outs for certain industries that are where the need for those goods, to have large supply of these goods rapidly at reasonable prices benefits the country overall. I mean, it's I think how we look at natural disaster policy in this country, unfortunately, is becoming very, very heavily politicized. You've got, even before Trump was sworn back into office this week, you already had he and Governor Newsom of California hurling epithets at one another, over social media. So, and we have threats of withholding aid unless there's some sort of conditions that are met. Maybe sometimes that would actually be a good thing. And so we don't have a lot of focus on the long run. Earlier today, I mentioned I was on another webinar. One of them had to do with insurers who are investing in what's called natural capital. And that means, so think broadly about natural resources and things like this, although it can involve some other things. So, you think about in the future, out there in Davos at the World Economic Forum right now, they view over the long run, one of the greatest issues is going to be, disruptions associated with natural resources. And so you can talk about even wars breaking out in some parts of the world over water, for instance, or over arable land, these kinds of things. And so is it a good, perhaps something that insurers can do that would be not only provide a good rate of return on investment, this is part of the discussion in this webinar, but would also be something that was part of a solution. So you think about California, they do have a wet season and trillions of gallons of water go running out into the Pacific Ocean. Wouldn't it be nice if insurers and others could get together with the state of California and position these investments so that they see that California, irrespective of your political stripes, see this as a strategic investment. So we're thinking about investments that enhance the geopolitical security, the economic security of the United States. Building up this country's water reserves, for instance, in dry states is at least as important as building up. We have a national petroleum reserve. Well,
Right.
Wouldn't it make sense for every state to have a kind of a national water reserve, or whatever scarce resource they have? And so, if we can kind of be of part of what helps drive us away from this view that anything environmental is sort of some pure liberal cause, as opposed to something that is strategic and of mutual benefit to Republicans and Democrats alike,
Right.
then I think we'll be a stronger nation.
I agree with that. I love that perspective. Well, here's a fun one. Our last question. Please put more questions in the chat. What's the impact of crypto, you think, on the economy and on potentially on insurers? Certainly, blockchain has a place for in some areas. So, crypto itself, the coins and Bitcoin, Ethereum, those kinds of things. What do you think in terms of both crypto and blockchain in terms of an impact on the industry potentially?
Well, in crypto and blockchain, in my view, are two different things. I mean, blockchain is a technology that sort of facilitates crypto, but there are people who are a lot smarter than I am in the world of finance, like Jamie Dimon, the CEO of JP Morgan Chase, the biggest bank in the United States. He's never been a big fan of crypto, but you see CEOs of other banks, CEO of Bank of America, Brian Moynihan, he says, well, I don't know that he's a huge believer in it, whatever, but he says, well, is this a market we can participate in? Yeah, we can do it. So, crypto, in my view, it still remains very popular with crooks and thieves and hackers and North Korea and things like this. But there are enough of people who want to transact in crypto that a bank, for instance, can make a market out of it. So they could put together buyers and sellers. It doesn't mean they're going to do a lot of speculation in it, but they find a way to make money out of it. I can't fault them if there's money to be made. So, someday will insurers are there some insurers who might someday take payment in crypto? Sure, why not? There are life insurers right now who have cash value policies or variable annuity policies that allow you to invest in some kind of a crypto fund because you direct your own investments and that sort of thing. You are taking on all the risk. If you lose all your money and you don't have any money in your retirement or no money for your heirs when you die, well, that's your own fault. So as long as people know that they are, what kind of risk they are undertaking, and again, don't expect some kind of federal bailout someday, that
Right.
sort of a thing. Personally, I believe it's more akin to gambling than I think of anything else. You look at the crypto movements of cryptocurrencies, it's much more associated with movements in tech stocks and these sorts of things. And again, not to get political, but anyone can create a new cryptocurrency or a coin. You saw some new ones. The new president and his wife created a crypto coin, a coin just shortly before the inauguration, and now apparently they're worth a few $1 billion. Now they're only worth that because people talk these things up, and they are very, very vulnerable to what I would call pump and dump strategies.
Yes.
So there's an asset that doesn't have any underlying intrinsic value, but you talk it up, then you get out of the position, and then later on it can collapse.
It's probably similar to if tell me if this is a good analogy to the it was Radio Shack trend that happened in stocks where
meme stocks, meme stocks, and so there's a huge proliferation of these digital currencies right now where they have absolutely nothing backing them, except people think it's cool.
Yeah. Yeah.
So,
Well, thank you on that. We got some good questions coming in here. Thank you, Kim Andrews McClellan. What amount, it says, what amount of lack of risk management led to the California wildfires? And it sounds like asking the question, what did insurers do or not do? I believe is where that's going.
well, there's a couple, if I look at lack of mismanagement by the California Insurance Department, there was an infinite lack of mismanagement there. It was obvious what was going to happen. It was just a matter of if, not when. But in terms of lack of, when you look around, the Pacific Palisades area and other areas that were affected, you're looking at, multi-million-dollar homes built on steep slopes with a lot of vegetation around them, not far from areas that had had significant wildfires in the past. So it was a disaster waiting to happen. It happened. People act like they're surprised. I'm not surprised.
Yeah.
Very few people in the insurance industry would be surprised
Right.
to see that. It's tragic, but it is not something that insurers hadn't anticipated, and that's why you don't see insurers going bankrupt left and right. Okay, 9/11 is something they hadn't anticipated. Okay, 9/11 is a good example of that. And maybe something like Hurricane Andrews 30 years ago, which was kind of the we had hurricanes, but nothing really like that in that kind of a populated area. But I'd say this day and age, there's not really much that surprises insurers in terms of, natural phenomena. I would say that they're very much surprised sometimes by the degree of dysfunction in tort environment or in the regulatory environment. You can't cease to be surprised at these sorts of things sometimes, other than that it happens. But trial lawyers are endlessly creative. But yeah, and so to the extent that they build back, and we hear from the people whose homes were destroyed, the first thing they want to do is they're going to build back. Yeah. But are they going to build back better? Are they going to build back stronger? Are they going to build back smarter? That's another question. Yeah. And we'll have to see. Are we just going to build another $50 billion ticking time bomb?
Yeah, absolutely. Thank you. James, VP of Risk Management and Insurance at Haverty's, has a question. How long do you think before AI is used to underwrite commercial insurance?
Well, I'd say to some extent it already is, being dabbled in right now. There are certainly concerns, for instance, again, out in Davos at the World Economic Forum, they also, in addition to the risk report, they put out a report about employment and what jobs they expected to increase or decrease over the careers, over the next several years or decade. And, very vulnerable on their list are things like people on the claims side of the equation. Now, I think they over-exaggerate a bit, but because, claims will also become ever more complex and require more brain power, including human brain power, to work their way through. But I would say, yeah, certainly there's some vulnerability there. There's no question that technology has helped underwriting, and it has for many decades, and that will continue to be the case. I'm not so sure I would go out on a limb and say, because of AI, we're going to expect to see 50% of underwriter positions eliminated over the next decade or so.
You're not saying that, right?
I'm not saying that. Yeah, I think that there's an opportunity for people coming into the industry today, or people who've been in the industry for years, to upgrade their skills. I see that with my students who get hired into excess and surplus lines carriers on the broker side or on the underwriting side, and they're on a learning curve. Okay, they're going to be one that's going to run their whole career. And I tell them that you need to keep up with these things if you're. But I would, if you want to stay gainfully employed the rest of your life. But I would give them the same. I would give them exactly the same advice if they were majoring in, chemistry right now or engineering. You can't let your skills, your knowledge set become obsolete, and that's going to be the key to success. So, what was it? Century and a half ago, they wanted to close the patent office because they thought everything that would have been it was invented. We're not closing the underwriting office. We're not closing the claims office. It's not going to be some cyborg behind the door that is kind of running everything. It's going to continue to be a business that is going to be based, at least for the foreseeable future, on quite a bit of personal relationships.
Yeah. It's a relationship business when it comes down to it. It really is. So Laura Townsend's got a question. And it's something we like to talk about here at WSRB just because it's an interesting concept. 10 billion is invested just last year in the parametric side of insurance. Is that a viable last ditch option for the middle market client that can afford it?
I like the idea of the parametric market. I think it makes it creates some certainty and adds some speed, I think, to for which in terms of the claims process, and I think that's good. I would expect to see some continued growth there. Is it viable last ditch option for the middle market client who can afford it? I'm not sure I can answer that question because I'm not sure why is it necessarily a last ditch option. I'm not really sure what we're getting at there. But do I think parametric in general has a lot of opportunity to grow? I would say yes, it is.
Because it's I don't want to say obscure, but it's not like an auto home, general liability type policy. I heard parametric kind of explained as sort of like an AFLAC if you look at health insurance. That can you give just kind of a little bit of an overview of how parametric works in principle for anyone who might be on the call that's familiar?
So in general, if we have a parametrics coming from the word parameters, so basically we can think about a policy being triggered by one or more criteria. And so as opposed to waiting for a claim to be adjusted and adding up the dollars and see how much you might get, and or for an insurer, with a reinsurance contract, waiting through the hurricane season to see how much the losses are, or for a particular event, how much the losses were for a particular storm or a particular wildfire or what have you. If it's a named storm within 50 miles of a certain longitude and latitude, then with wind speeds exceeding a certain speed for a certain period of time, these things can be heavily customized. Then the policy pays out.
Everybody gets it. It's the same amount. You know what you're going to get. Pays out automatically without an adjustment process.
And everybody is aware of that.
Yeah.
So I kind of like the concept. It's not quite as pure of an insurance product, if you will, of just indemnifying actual losses. So in some cases, for parametric might happen. A company might have a big loss and they get nothing. They might have a small loss and they get a lot, or no loss and they get a lot. So it's not perfect in that sense, but there are some advantages to it.
Well, but part of the concept that I've heard kicked around as well is that it could be used as a way to offset deductibles as well. You do have an actual loss that you have a certain amount you're planning on, so it pays out a flat amount based on parameters that are unrelated to the actual concept property, but where loss is likely, right? That's the concept. So we've just got 3 minutes left in our hour. Bob, thanks so much for some great answers that you've given and the great overview. What would you say as a closing comment to our participants here with us today?
Well, again, the industry has been much in the news over the past few months, not just from the California wildfires, but rising auto insurance prices, which last year reached a peak, almost 22% at one point during the year on renewals. And again, to kind of go for a full circle, the headlines you're not reading are, Acme Insurance Company in Washington State went under. Right. And ABC Insurance Company in California went under, and XYZ Insurance Company in Florida went under. Okay, and leaving hundreds of thousands of policyholders with no means of recovery. What you might be reading, right? So what you are reading is that insurers are paying the claims for the policies that they have. And what insurers are doing, is as odd as this might sound to some people, when insurers in California, because they're not allowed to charge a risk appropriate premium on non-renewing policies, what they are doing is ensuring that they can go down the promises that they made for the millions of other policyholders that they have. The last thing they want to understand, that the last thing the insurer wants to do is basically shed business. It wrote that business originally because it thought it was good business. It was profitable business. It was consistent with their growth and profitability plan. What got in the way wasn't Mother Nature. What got in the way was the Department of Insurance or some piece of legislation or the trial lawyers. And those are the biggest obstacles to, I think, the smooth functioning of many insurance markets in this country.
I hear you. I've often said that something similar. There is no motivation for an insurance company to lose a customer. There's plenty of competition out there. They're highly incentivized to treat that customer right, but they do have to do it within the insurance ecosystem. If they didn't charge a premium for that loss, they can't make money on it. That's taking money from the other policyholders, right? So thank you so much, Bob, for being with us today. We appreciate your service on our board. We appreciate you helping us as you've explained economic concepts to us today. Looking forward to hopefully doing this again with you next year, if you're willing. And we're excited to, we got some thank yous in the chat as well. So thank yous from the participants coming at us, and look forward to our next Insurance Leadership Webinar series coming up in a couple of months.